Let's cast our minds back briefly to the early 2000s, to Ben Bernanke and to his famous savings glut hypothesis. So you remember back then, the Fed was hiking rates, so short-term rates were going up, but Treasury borrowing costs stayed low. And Bernanke said, you know what? There's a glut of global saving, all of this money coming into the US from China, from Saudi Arabia, and that means the Fed can move the short end, but long-term borrowing costs are going to stay low. So the big argument that we make in this book, written by my colleagues at Bloomberg Economics, edited by me, by Jamie Rush, by Stephanie Flanders, is that that savings glut is now gone. And the reality confronting the world and the US is a savings shortage. And what that means is that President Trump can appoint whoever he likes as the next Fed chair. He can appoint Kevin Hassett. He could appoint Kevin Warsh. He could train an AI algorithm to mimic the decision-making of Arthur Burns, the Fed chair in the 1970s, who gifted Nixon rate cuts and won him the 1972 election. And that would mean the Fed policy rate went down. But for long-term borrowing costs, we think this savings shortage is going to be the dominant driver. We think the new normal for the 10-year Treasury is around 4.5%.
Wow. Well, I'm sure Scott Bessent is not going to want to hear this today. If we did start to see interest rate cuts, maybe 50 basis points in September, for instance, I'm curious what it would mean for the housing market, the direct relationship that we see with mortgage rates, because it does sound like the administration is banking on a loosening in the housing market, helping to offset some of these headwinds that you're talking about.
So the next move for the Federal Reserve is very likely to be a rate cut, right? We've just had some really weak jobs data, July coming in weaker than expected, major downward revisions to May and June. We've had the surprise exit of Adriana Kugler from the Fed board, and we heard yesterday that she'll be replaced by Stephen Miran, currently the head of the Council of Economic Advisors. I'm sure he'll be voting for a cut. Put those pieces together, and it's very likely that the Fed will be cutting rates, perhaps not at September, but certainly before the end of the year. The bigger reality, though, Joe, and the reality that we attempt to address in our new book, is that for the economy as a whole, it's not the Fed's policy rate that's the most important thing, right? It's the 10-year Treasury which sets borrowing costs across the economy as a whole. And for that, we think this savings shortage is going to be the dominant factor. We think that means that even if Trump gets a loyalist in as Fed chair, even if he gets the Fed policy rate down, long-term borrowing costs are going to stay high. And to come back to your question, that's going to be challenging for real estate, challenging for stocks.
I talked to Stephen Miran yesterday. Incidentally, it was about an hour before the president announced that he would be his nominee to fill this seat being vacated today, I believe, by Governor Kugler that you mentioned. And we were talking about the inflationary or not impact of tariffs. This administration argues every day that a one-time change in prices does not equal inflation, and as he described, they proved this in the first term. Listen to what Stephen Miran said, the chair of the White House Council of Economic Advisors, here on Bloomberg.
You're right. There's been a lot of conversation about this subject, and I think that a few things are worth mentioning. One, we ran this experiment in 2018, 2019. We saw zero macroeconomically significant evidence of tariff-driven inflation then. Two, we've been running higher tariffs in this administration since the very first day, since January 20th. We've now got several months of data, and again, there's just zero macroeconomically significant evidence of price pressures from tariffs. Three, the overall policy mix is extremely disinflationary.
This is the new addition, assuming he gets confirmed, to the Federal Reserve Board. What's the Orlik take on what he just said?
Well, firstly, Joe, I think the logical conclusion from Miran appearing on your show and then getting the nod for the Fed board is that the White House personnel office are watching the show and making their decisions based on that.
We're on in the West Wing every day. Be careful what you say.
So I should say, just for clarity, I'm flattered that you would think of me, but I think Chair Powell's doing a great job, and I'm very happy at Bloomberg Economics.
Well done.
So more seriously, and coming back to your question, so I think what we heard there from Stephen Miran was a very clear view that tariffs are not going to be inflationary. And the view in the Fed, of course, is, well, probably they are going to be inflationary. So Fed staff, many on the Fed board, are nervous about cutting interest rates because they think, well, we haven't seen the tariff impact just yet, but maybe that's because everyone front-run the tariffs, stocked up on inventory. Maybe the tariff impact on inflation is still to come. We have to stay cautious. What we heard from Stephen Miran is, well, I don't accept that view. I don't think tariffs are going to be causing inflation. And implicit in that is the idea that actually the Fed just can get on with it and start cutting now. And so I think what that tells us is that Miran's appointment sets up some interesting conversations, probably some dissents and some conflict on the Fed board.